All right, welcome back in here to Live Now from Fox. I'm Andy Mack. Due to the government shutdown, the Bureau of Labor Statistics will not release their jobs report until after the Fed Reserve meets next week. But we're getting a glimpse right now into some of the private sector jobs. There's new information from ADP showing that 32,000 jobs were lost in that private sector in November. And this is important because this is the last picture, really, the Fed Reserve and those governors have before they weigh another rate cut. According to this report from ADP, large businesses, they gained some 90,000 workers, but small businesses wiped out those gains with a drop of 120,000, leading to that 30,000 drop in that private sector. Let's be joined right now by senior economics writer for Barron's, Megan Leonhardt. Thank you so much for joining us here on Live Now from Fox. How do we square this? How does the Fed Reserve and the governors view this heading into next week?
Well, I think we know that the committee is pretty divided on, exactly how things are going to shake out next week. You do have a number of officials who are very concerned about the persistent inflation being above their 2% target. They think that that might actually be the stronger risk at the moment. And then you have about half the committee who is very concerned about the very weak labor conditions. Now, it really comes down to which is the bigger risk. And I think right now, the data that we have on hand, and certainly that we saw from ADP, was not particularly great news today. We had that they were shedding about 32,000 jobs last month from private payrolls. And while that isn't the entirety of the employment picture, it is a pretty good indicator that we are having very weak conditions. Even if you take the 3-month average, we're still in kind of negative territory for the last 3 months. And that is something to consider, and certainly maybe not a collapsing labor market, maybe not a recession, but certainly something that the Fed officials will want to take a very close look at. And this does tilt closer to that potential rate cut for next week.
And you mentioned that just the trend line of this, because dating back to October, it was a gain in numbers. This one obviously down in the negative, some 30,000. How do they square that? And maybe looking back to November, because sometimes during the holidays, you have to kind of square these looking at year over year versus just kind of this trend line. How do they look at that?
Well, it's been interesting because obviously the employment data has been pretty volatile month to month and even week to week. I think one of the other key indicators that we're watching very closely is the number of Americans applying for that initial unemployment benefits. That's something that has actually remained pretty steady. So it does look like we're not seeing a ton of layoffs start to really hit, even though we did see those big announcements. That's encouraging and certainly, again, helping that narrative that we're not having that collapsing labor market per se. But it is something where, you start to look again at that trend line and, you really start to dig into sectors. Obviously, healthcare, education, holding up pretty well. Even leisure and hospitality from the latest report from today, really seeing some decent stability there. But when it comes to things like small businesses, for example, that has been a sector that has been really under pressure for much of the year. And certainly since that liberation tariff announcements that really did, worry small businesses. We obviously got, a lot of headlines, right after that about how small businesses were very concerned. You're now starting to see that really play out in their labor decisions, particularly around this time of year, when we would expect to actually see small businesses retaining and actually increasing their headcount for those holiday sale months.
And can we get into that a little bit more? Sometimes we talk about the exact sectors that are impacted, but the large versus small, the discrepancy between the two in this ADP report is certainly grand. And we're talking about large businesses, but those are only 50 plus employees, small businesses less than obviously 49. Can you square that? How do they view it versus large versus small, taking the brunt of some of this obviously weakening job report in terms of small businesses?
I think over the last couple of years, small businesses have really taken it on the chin when it comes to many of the economic headwinds. In fact, they may be in more precarious circumstances than even your average household, because not only have they had to weather inflation and, of course, the tariff squeeze on their margins, but they've also had labor issues, generally speaking, just being able to hire the right people for their businesses for years now. And this is something that is really coming home to roost. I would argue that given, some of the headwinds on the horizons and certainly some of the wherewithal that they've had to put in this year, that small businesses are, muddling through, but they certainly aren't thriving at the moment. And you do have to remember that small businesses do make up a significant portion of the labor market. It is funny because we do see all the headlines talking about, the big boys, and they're certainly what they're doing and all the data centers that they're building or, the potential layoffs that they're having. We are very concerned, but they are a little bit better positioned to, sort of deal with those macro headwinds than some of the smaller players.
Yeah, and obviously they have a little bit more buffer in terms of just the size of the company. I do want to ask you because we are going to have that meeting next week with the Federal Reserve, and then we're expected to get that report from the Bureau of Labor Statistics. If those numbers don't match up, if there's not a rate cut and then it comes back with a maybe good jobs report or vice versa, if they do give a rate cut and then the jobs report comes bad, how will investors react if they don't square up?
I do think that the markets could be a little choppy over the next couple of weeks, but keep in mind that, okay, even if the Fed doesn't cut next week as sort of anticipated at the moment, and again, I do think that while market expectations are really pricing in a cut, I do want to specify and really stress that this is going to be a very close decision. And, okay, so they don't cut. They do have January as well. You have to remember that, it does take a little bit of time for, these rate cuts to really move through the system. We're talking about a percentage point rate cut. It's not the end of the world if we don't see a cut, and they have the opportunity to cut again in January then.
That is a very good point. And we could soon see early next year President Trump talking about that new Fed Reserve chair. So it could be a whole new ball game next year in 2026. Megan, anything else we're missing? Anything else you want to note before I let you go?
Well, you did bring up the delay, and I do want to point out that it is interesting. We do have much of this delayed data coming in, but it is going to be wonky. I want to stress that even once we get this data, it isn't the same typical data reports that we're getting on inflation, unemployment, and even some of the GDP numbers that we're expecting in December for third quarter. We are going to see some discrepancies. It's going to be a noisy data period. I really don't think that we're going to see smoother trend lines until January.
Yeah, you said it very well, and I think you used the exact technical term wonky very well there. All right, Megan, thank you so much. I appreciate your time. Great breaking it all down here on Live Now.
Thanks so much.